Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, in an ever fluctuating economic landscape, when central banks are acquiring more of the yellow metal, should you consider investing in gold? And is there a case for gold ETFs? We'll discuss that and more with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
First of all, let's begin with the case for investing in gold. Your opinion has undergone a change over the past year or so. Can you share some insights on that?
For 20 years, I've been telling that don't invest in gold, it's not an asset. But it has become an interesting diversification for investors simply because central bankers are buying gold. The real reason why central bankers are buying gold, it is primarily to insulate themselves from the dollar risk or the fiat currency that governments all over the world are printing money, and not having currency but having gold, it's actually increasingly playing the role of a currency which has some intrinsic worth or has the potential to be a superior store of value, and that new demand has actually is translating into return for investors. And that is why I think that it will sustain itself. Second reason why I think gold is becoming a little more interesting is that we are seeing a unidirectional market. Governments all over the world are printing money and they're borrowing. So debt has become increasingly vulnerable. First time gold came into prominence was sometime little before 2008, when the financialization of gold was happening. It was possible to buy a gold ETF or a gold, have proportionate ownership of gold without physically owning gold. And you were able to ride the appreciation or ride the prices of gold. And that was little before 2008. And 2008 was a landmark year in terms of, acceptability of gold as an investment. Because that was the time when equity collapsed and so did fixed income, and that too in America. So the only island where nothing happened or it actually benefited as a result of all this mess or the crisis, the financial crisis, was gold. And gold was the only island of appreciation. Everything else was collapsing. So that actually brought gold on the forefront. And the case for gold as it got built then, all those variables remain in place. It is still valid. So that is why it is a meaningful diversification, and it will also hold its value. And that is why have gold. Look at it as a hedge, not as your primary investment. I have changed my view. That doesn't mean that gold should be your only thing in the portfolio. Have a bit, because that is a part of your investment which is completely unrelated or not correlated to the equity and the debt.
All right. Moving on, can you explain what gold ETFs really are?
Think of it like a gold fund. When you invest in an equity fund, you give your money to a fund manager and he buys the equity. When you buy a debt fund, similar, gilt fund, debt fund, whatever. Here, the gold fund has a single investment, which is gold. You give your money to a gold fund and he buys gold. And the ETF format of a mutual fund is that fund gets created, and then different people who own that gold fund, they are selling in the market and you can buy it from the market. You don't buy it from the fund company directly. That is the design of any ETF. And that is the difference between an ETF and any mutual fund. When you buy a mutual fund, you give your money to a mutual fund and it issues those units. When you buy an ETF, you place your order with the stockbroker. And the stockbroker is enabled to pass on that order or do the matchmaking of the order against some seller who will be owning that ETF. So you are buying from somebody who already has it. ETFs can be created and can also be cancelled. So there isn't a steep premium or discount to them. So you are effectively, most investors should look at it like gold ETF is a gold fund which you buy through a stockbroker.
All right. Now, in the light of current economic conditions, and you also mentioned that now is the time to increase exposure to gold, maybe, or have some exposure to gold. So, what's the case for gold ETFs there? Should one?
Gold ETF, as you know, I've been telling for a while that for a couple of years or maybe 5-10 years, that there are different ways in which you can hold gold. One is sovereign gold bonds, and government has been issuing it. Government did not want investors to buy physical gold because that is a very unproductive way of owning any asset. So they started creating something called sovereign gold bonds. You were able to ride the price of gold. You were able to get 2.5% more than that. And for 8 years, whatever is the appreciation, that was completely tax-free. And what has happened, because gold prices have gone up so dramatically, that government seems to be, it is beginning to come out with these issuance anymore. It's no longer coming at that periodicity, at that frequently, and looks like it may not. There are reports. I'm not very confident of the source or the veracity of it, but looks like last issue was last December, so 8-9 months. Otherwise, there used to be one issuance, one bond offering, new bond being created every 2-3 months. So looks like government is discontinuing. You can still buy them because it's listed in the market. But buying from the market is no longer an option because the market price is at 8 to 10% premium to the gold prices. Right. So it doesn't make sense to be buying at that kind of premium unless you think that gold prices will go up so dramatically that paying a 8% premium for these bonds for the residual maturity might be worthwhile. So this was one option. You buy, looking at gold in the non-physical form, because the physical forms are the most useless forms. One is the jewelry, where the making charges and the, so I think that jewelry, when you own gold in the jewelry form, that's the most inefficient one if you are looking at gold as an investment. It is very valuable and it is interesting if you are using it for the reason it is, that it's jewelry. You can show it off, you can feel happy about it, and look at it as a consumption. But else than that, if it's jewelry and if it's bar, coin and other things, the liquidity and other thing is compromised. Liquidity, purity, all other things. And if you have too much of it, you might also have to guard it. You have it could be a security hazard. So non-financial, non-physical forms are these: gold ETF, gold funds, and sovereign gold bonds. Now, sovereign gold bonds sovereign gold bonds from the market and from the new issuance. New issuance, it's ruled out. From the market, ruled out because now it is 8-10% premium. Then comes gold ETF and gold funds. Every gold fund that has been created invests in a gold ETF. So it is nothing but something which has been created for the sake of convenience. Most investors, most ordinary investors, if they have to buy gold in a financial form, then they buy the gold fund. You don't need a demat account. You don't need to go to the market. Or if you have a demat account, if you have an account with a stockbroker, you can buy the gold ETF. Buying that gold ETF, there is there's a little bit of difference for common investors, which is when you buy the gold ETF from the market, it may not always trade precisely at the NAV. It could be a little bit more or less than the NAV simply because there could be a demand and supply mismatch in the market on a temporary basis. So you have to be a little careful while buying this. So buying these ETFs, you have to be a little careful. If you want to be insulated from this, then buy the gold fund. So these are the two formats which is still available. There is a difference in the cost of it, which is gold ETF has an expense ratio and gold fund has an expense ratio of its own. So there is there are two expense ratio. One is the expense ratio of the underlying fund where these gold funds will be investing of the ETF, and then their expense ratio itself. So there could be a cost implication. The gold prices will appreciate or depreciate as it is, and your return will be gold prices appreciation or depreciation less expenses. So lesser the expense, better it is. Gold fund have two expenses, gold ETF has just one expense, but it has the inefficiency that you may not get at NAV.
All right, now moving on, what are the potential risks that investors should be aware of while deciding to invest in gold ETF?
Gold ETF will have the same risk as if you own gold, except that in a financial form. It reduces some of the risk that you don't have to worry about the purity or the liquidity. You will be able to realize it. But by and large, all the market risk. If gold prices go up, it will benefit. If they go down, you'll be hurt. There will be depreciation. Your value will go down. And it is important to remember that gold prices, people think that gold, this is gold, that's a metaphor of, something which holds value. But that may not always be true. There has been a prolonged period of time when gold has lost value, and that is a risk which one should be aware of. Rest of the risks, are reasonably covered in terms of liquidity and the purity and other things. And also, gold ETF has existed in India for a while. That, most of the operational glitches or the operating risk of running a gold fund, a gold ETF, has come down dramatically because, it has been thought through, revised, updated, and now it is a 15-year-old story.
All right, so that's about gold ETFs. Now, moving on to a viewer's question. Ganesh Prasad has sent in this question. He's asking, is investing in a conservative hybrid fund sufficient for one's debt allocation, or is a GSEC index fund or similar debt indices necessary?
No, I think, if you're thinking of, having a fixed income allocation or fixed income investment for stability of your investment, and it's going to be a long-term investment, then you should consider a conservative hybrid fund, simply because, it will have the automatic rebalancing. It will potentially generate more return than what a, standalone fixed income return will produce. And it's very important that if you are going to hold fixed income for a very long period of time, choose a vehicle which will automatically rebalance. Because if you have to do this with two investments yourself, now there is a cost of rebalancing. You move your money from equity to debt and pay 12.5% capital gains on that gain. If you move your money from fixed income to equity, all the gains will be taxable in your hand. So to save on the taxes and to keep it simple, it's very useful to have, conservative hybrid fund as your fixed income allocation, simply because, it will be convenient, it will be tax efficient, and automatic rebalancing without any worry.
All right, Ganesh, hope that answers your query. That's all we have for you in this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.